Welcome to our journey into the world of profit maximization, a fundamental concept in economics. Imagine a bustling marketplace where firms strive not just to survive, but to thrive. At the heart of their strategy lies the balance between marginal cost and marginal revenue. Each decision a firm makes is like a chess move, calculated and precise. The goal? To reach that sweet spot where the cost of producing one more unit equals the revenue it brings in. This is the essence of profit maximization. By understanding this balance, firms can determine the optimal level of production, ensuring they are neither overproducing nor missing out on potential profits. As we delve deeper, we'll uncover how this principle guides firms in competitive markets, influencing their choices and shaping their success. Whether you're a student embarking on your economics journey or an educator seeking to illuminate these concepts, this exploration will equip you with the tools to grasp the intricacies of profit maximization. Let's begin this insightful adventure, unlocking the secrets that drive economic decision-making. In economics, the profit maximization rule is a cornerstone for decision-making in competitive markets. This rule dictates that firms achieve maximum profitability by producing at the point where marginal cost equals marginal revenue, often denoted as MC equals MR. Imagine a scenario where a firm evaluates the cost of producing one additional unit against the revenue it generates. If the revenue from selling that unit exceeds the cost, the firm increases production. Conversely, if the cost surpasses the revenue, production is scaled back. The significance of this rule cannot be overstated. It serves as a critical tool for firms navigating competitive markets. By adhering to the profit maximization rule, firms optimize their production processes and strategically position themselves for long-term success. Understanding and applying the profit maximization rule empowers firms to operate efficiently within their industries. In the realm of profit maximization, two key concepts stand out: marginal revenue and marginal cost. Let's explore these pivotal elements that guide firms in deciding their production levels. Marginal revenue, often abbreviated as MR, represents the additional income a firm gains from selling one more unit of its product. It's like the extra slice of pie you get when you sell just one more piece. On the other hand, we have marginal cost, or MC, which is the extra expense incurred from producing that additional unit. Think of it as the cost of ingredients for that extra slice. Understanding these concepts is crucial for any firm aiming to maximize profits. The golden rule of profit maximization is to produce up to the point where marginal cost equals marginal revenue. At this juncture, every unit produced adds exactly as much to revenue as it does to cost, ensuring no resources are wasted and profits are optimized. Imagine a bakery deciding how many loaves of bread to bake each day. By calculating the marginal cost of baking an additional loaf and comparing it to the marginal revenue from selling it, the bakery can determine the most profitable number of loaves to produce. This balance is essential in competitive markets, where efficiency and precision in decision-making make all the difference. In perfect competition, efficiency is not just a goal, it's a necessity. Here, countless firms vie for consumer attention, offering identical products at market-driven prices. The stakes are high, and only the most efficient survive. This is where the concept of the shutdown point becomes pivotal. Imagine a scenario where a firm's revenue barely covers its variable costs. This is the shutdown point, a critical threshold that determines a firm's ability to continue operations. If revenue dips below variable costs, the firm faces a tough decision to halt production. This isn't just about short-term survival, it's about strategic foresight. In perfect competition, firms must constantly evaluate their cost structures and market conditions to ensure they remain above this vital line. It's a delicate balance, where efficiency dictates longevity and success in the marketplace. Understanding these dynamics is crucial for firms aiming to thrive in competitive environments. In the long run, decision-making becomes pivotal for firms striving to sustain their operations. The focus shifts from short-term survival to long-term viability. The key question is whether a firm can cover all its costs, both fixed and variable. If not, continuing operations may no longer be feasible. This is where the concept of market exit comes into play. Consider a firm unable to generate enough revenue to cover its total costs. In such scenarios, the decision to exit the market isn't just a choice, it's a necessity. This decision-making process requires a strategic evaluation of all financial aspects to determine whether staying in business is sustainable or if exiting is the prudent path. Ultimately, long-run decisions are about ensuring that a firm's resources are optimally allocated, maximizing efficiency and profitability. By understanding these dynamics, firms can better navigate the complexities of competitive markets, making informed choices that align with their long-term goals. As we conclude our exploration of profit maximization, let's delve into real-life scenarios where these economic principles come to life. In agriculture, farmers must decide how much crop to plant to ensure that the cost of production, including seeds and labor, aligns with the revenue from selling their produce. By applying the profit maximization rule, they can determine the optimal quantity that maximizes their earnings. Similarly, in the retail sector, businesses constantly evaluate their inventory levels. Retailers aim to balance the cost of stocking goods with the revenue generated from sales. By understanding marginal cost and marginal revenue, they can make informed decisions about which products to stock more of and when to offer discounts to clear inventory. These examples highlight the practical application of economic theories, demonstrating how businesses across various industries use profit maximization to thrive in competitive markets. By mastering these principles, firms can navigate complex economic landscapes, ensuring sustainable growth and profitability. Thank you for joining us on this journey through AP Microeconomics. For more insights, remember to subscribe to AP Television.